because the Federal Reserve's cutting rates this time doesn't mean mortgage rates are going to drop. So we're talking rates today. We're going to talk about what the Federal Reserve's going to do and how those might really not change mortgage rates at all, folks. My name is Dan Frio. My whole goal each day is to come in and explain to you guys what the heck's going on with mortgage rates and the whys behind it. Today's news is the Fed and nothing but the Fed. So here's what we're looking at. Here's the news that the Federal Reserve watches. Okay, they watch the PCE. That number just came out recently, and it's the inflation number. Okay, it's way above the 2% mark. The unemployment rate, it's 4.4, and the JOLT numbers yesterday aren't looking any better for these things. So the unemployment rate may be ticking up a little bit more based on that news yesterday. So the Federal Reserve, they're cutting rates, but inflation's up, and the employment numbers aren't really falling off a cliff. So are these cuts really going to change mortgage rates? Well, mortgage rates are most focused in on those things down there. The inflation's high, employment rate's still under 5, that's full employment, and then it's right through here. This is one of the biggest things that really controls the long end of the bond market, which really controls mortgage rates. A little bit confused on this. Let me explain this to you. If you're new to my channel, here's what we really follow to figure out what's going on with mortgage rates. Right through there. That's a mortgage bond. If you see at the top up there, it says MBS 5.5. What you have to look at is what the price is doing. Okay, so here's what I mean. If the price up there is going up, that means rates are coming down. We want this to rally up. But the Federal Reserve cut rates last September. This is just the previous September. It's right through here. The number that when they cut was 101. Here, I wrote it down. 101.3. It was right there. 101.25 to 101.445. Okay, that's the price of the bond. I'm getting somewhere. If you look at it today, right up through there, 101.75. Okay, that means it's lower. So the bond price is down from where we were. Well, remember, if bond prices go down, rates go up. Well, that's what happened. So the Federal Reserve cuts and mortgage rates go up. Why? Well, because they're looking at things like this. They're looking at the inflation numbers. They're still higher than 2%. They're looking at the unemployment rate. They're still under 5%. So they're saying, okay, the inflation's too high. The jobs market's okay. Do we really need to cut? Well, they're kind of being forced into this rate cut, but that doesn't really mean that mortgage rates are going to be forced into coming down lower because inflation's not coming down. The jobs market isn't really getting any better, and our national debt just keeps getting worse and worse and worse. So now the other pieces of this puzzle we have to look at are tariffs.